The reason why I'm making this video is because there is a ton of information that gets circulated online that is wrong and doesn't help daily consumers, whether it's for personal needs or business needs. I hope if you're watching this video that you find something useful from me, from all my knowledge and experience working with banks and in finance. A little about myself before I get into the rest of the video. I've worked as a teller, and from a teller, I transitioned to a personal banker, then a business banker, and now I work as a business consultant, or a less fancy word, as a loan officer for small to medium-sized enterprises. And that's just another $5 word for saying I work with businesses that generate revenue of $500,000 to $50 million a year. Now this brings me to my title, Why Banks Suck, but They Don't Steal Your Money. The banks suck because there is no other place on earth where you can keep your money safely, knowing that it's regulated and it's federally insured by the government. Now I know this creates a lot of insecurity for everyday consumers and businesses who keep their money at the bank. To your surprise, most banks won't care about personal checking accounts unless you have, I would say, 100,000 and over in the account. Banks borrow funds to make strategic opportunities for themselves. They're made to make money. Now, what does that mean for the everyday consumer? The only value is that you have a unit with them, and for every unit that you hold with the bank, it counts towards the bank's value or stock. But as long as you retain your relationship with the bank with a checking account, that's the only thing that matters to them. Whether you spend it all in one day or you keep the money in the account, it makes no difference to them. They understand for everyday consumers that maneuvering money, transferring funds is all part of the volatility with being a consumer. They won't touch your money if you're going to be moving funds in and out of the account, paying for things, spending money. It's too much of a risk and there's no point. So the only thing that matters is that you have a relationship with them. Now, why is this important as a consumer, whether you're a personal consumer or a business? This is important because no banker is ever going to tell you this information, but you have to take advantage of their products. The only products that really matter to the bank. You either invest your money with a financial advisor or you're taking credit. Now, this comes down to how you should interpret those. If you're looking to take credit, the most important thing is understanding how credit cards and their interest rates work. Most people are surprised by the interest rates of 25% all the way up to possibly 40%. It all depends on the bank's appetite for risk. Let's take, for example, that you want to foster a relationship with your bank and open a credit card. Now, let's say you're approved for $5,000 and you only want to use $2,000 of the credit card. Now, when you start out a balance of $2,000 and you're going to pay 30% interest, you're like, wow, that is a lot of interest to be paid. But how much are you actually paying? Are you actually doing the math? Or are you just conditioned to an APR, where you're just thinking that you're paying a lot of interest? And how is this calculated into your payments? There are many things to think about when considering something like an auto loan, a credit card, or a term loan that's amortized over 3 years. The most important thing is that you understand as the consumer how much interest you're actually paying. For example, on $2,000 with an APR of 30% and you're making 12 payments, so any percentage rate, your first payment is going to be $194.97. 50 of that is going to be towards interest. At the end of 12 months, if you don't pay it off early, the total interest that you would have paid back is $339.69. Now you might be thinking, wow, that's a lot of money that I paid in interest. Well, yes and no. You borrowed $2,000 and you had to pay that $2,000 back. So what does the bank get out of it? It has to be a mutually beneficial relationship. they had to get $339.69 off of the money that you decided to stretch over 12 months. If you're borrowing the bank's money, you have to pay it back. And the same principle applies to businesses. If you're a business owner who already has an existing business, or if you're looking to start your business, the most important thing is that you need to take a credit facility in order to make sure that your business is getting off the ground. So if I were you, I would take a term loan, a line of credit, a credit card, anything that's going to help with your expenditures. In a way, this is going to be your investment into the business. And if we think about it, there's no other place in the world where you can borrow money where you don't have to get your kneecaps broken. So what about investing? If you're an everyday consumer or a business and you're looking to invest, most of the time you're going to ask is, how should I invest my money? The one thing that I tell people now is think exactly as if you were in the CEO's shoes. What strategic opportunities or moves would you make to make sure the business is growing? If the business grows, there's going to be a return. And that's all. So debts that we take on as everyday consumers or small businesses, whenever you invest, that business is taking a debt in some sort. Now, you're expecting a return because you're expecting the business to grow. So we need to think about, or what risks can we mitigate to make sure that we're returning the money with some interest. For one, what I would say if I were to invest, this is in no way licensed guidance, but what I would say is you should look towards farms that are innovative, energy, medical, manufacturing that is spread across several industries, large banks, and technology. Now, these all seem very common and known investing sectors, but why are these important? Now, the examples that I've named are common knowledge nowadays. What I don't appreciate about a lot of everyday investors now is that they follow a trend, and whatever politicians, portfolio managers do, financial advisors do, is what most people follow. So this is going to help you determine whether or not a stock is worth investing to or not. Now, working in business finance, we look at a ton of small businesses every day. And as I said before, these businesses range from 500,000 to 50 million a year. What do we look for? We look for time in business. Are they stable, or are they in their startup phase? If they're in their startup phase, how rampant is their startup? Are we going to expect a 10x return on the investment that we're prepared to put into this company? These are all evaluated by financials and data. Most people don't invest based on data. They invest based on trends, and they're not making the appropriate steps to assess the risks. Now, another thing to consider is the industry. What industries are the most stable? These are the exact same industries as a loan officer that I would invest in, or I would extend credit to, because I know these industries are very stable. People need them. So, for example, medical. If you don't know what an AR is or an AP is, AR and AP, accounts receivable, is what the business is expected to get paid. And an AP is money going out. So this is what the businesses are expected to pay to suppliers, vendors, or other services that are on the books. Medical has short time frame for AR most of the time, and have a lot of revenue going in every month, making it very likely that this business is going to get funded. Now, adversely, let's think about construction. Construction is not a very stable industry. It might look great on paper for a lot of people, and it is very lucrative. But if you were a bank or if you were an investor, the scale of that investment needs to almost be like a guarantee, and that's going to be based on their financials and their past projects. Now, if you're an everyday consumer and you go to a financial advisor, they tell you all of these things about the yield that you're going to get on your investments. And let's say it's about 10 to 15%. You need to be thinking about the risks. Is it that high? Not, wow, that's a lot of money to be made. Because in the same way, you could lose just as much as you could gain. So if you're going to be gaining about 10, 15%, you could be losing about 10, 50% or more. Now, if your money is that precious to you, I would be researching a lot more than just investing my money wherever the money goes. Don't follow other people. Do your own due diligence and make sure that you're investing into industries that you actually appreciate. Overall, if you're a business or regular everyday consumer, the most important thing is that you should be having these conversations with your banker because they're getting paid basically nothing for their job. You should have an open conversation and make sure that you're getting what you need and that you don't have to go to a source like me. Or if you do want me to address some things here in the comment section, I will do that happily for you to make sure that you're getting a full understanding of what you should do moving forward if you have a trip or if you're looking to take a loan, whether it's a construction loan or somebody that's looking to make a business decision and they're having a difficult time. I'm here to make sure that everybody gets the help that they need. Thank you for watching. Bye-bye.